Welcome back to your channel. My name is Brad, and today I got a special guest with me, Cy from TSPY. That kind of rhymes. So, Cy, how's things going?
Doing great, Brad. Thanks for having me. Just wanted to get connected again and do a touch base since markets have been very unique over the past few months.
They have been very unique. So the last time we were talking, we talked about, you did some changes. You were going to do some call spreads under certain conditions. So how's that all going with you?
Yeah, I appreciate it. It's been really interesting since then. So the biggest, I think, change conditions are markets have been historically volatile, and investors we're all on edge. You're seeing different global political issues happening. Yesterday, was the day where Iran bombed a U.S. airbase, and the market went up. And so there's a very interesting dynamic at play internationally with those and how it impacts the markets here. And so kind of the lesson to take from it, I think, is that you can't predict markets, but you can just manage risk, and that's the game that we're in. And so to that end, we wanted to really beef up the capabilities that we have to manage TSPY with the underlying fintechs that that are providing the visibility to help us manage the fund. So we can talk a little bit about that if that's of interest.
Always my thought has been trade execution and what it takes to get from you picking a strike to the actual team actually doing this, because I don't think people understand. Cy doesn't hit the button and it's got to go through a whole chain of command before it gets to the traders.
It's such a good point. So having fast, precise trade execution is really important when you're playing the 0 DTE, covered call space. Our old setup, it was good, especially in the industry. It usually took about 15 to 20 seconds from when you hit the button to when the trade gets placed, and then it'll get filled. Solid, but you see how fast these markets move. So one of the things that we did since D-Day, which was April 9th, the big movement for 9.5% up run, was we wanted to be more responsive so that we can use tools like stop limits, but they have to execute quickly. And so what we did is we actually took a big upgrade and created a direct connection to our trading broker using this thing without getting too wonky. It's called FIX, the Financial Information Exchange. It's kind of like the bare metal institutional backend that lets you send trades. So now our trade execution went from being measured in seconds to milliseconds. And that has improved our limit order fills. It's hard to say exactly, but probably 10 to 15% better premiums compared to before. And that has a really meaningful, impact for investors and for fund performance. And when we get to the graphs, we can kind of see how it's done since we've actually implemented this, and you can see it in how the fund is performing.
So have you incorporated Truth Social and Trump's account direct link before he hits the send button into your algorithm of choosing strike prices? Because clearly doing fundamental analysis is not the way of going today. You have to be watching social media.
Events are such an important piece, and there's two kinds. There's planned and there's unplanned. So the planned ones, so when we know the day of where the administration says we're going to do a press conference from the Oval at 2 o'clock, it impacts what we do from a position standpoint, because you don't know what's going to happen, but it could move markets. So we do definitely take that into consideration. And then the hard part is no one has a crystal ball for before he hits the tweet button, but when he does, what can we do to make sure that we're actually being defensive about those events? And so absolutely, we have to have inputs from news events to help us manage a short-dated strategy. And we've done exactly that as one of the inputs into the back end that helps us manage the fund more effectively.
Now, you brought up the conversation of how have you been doing since those days? There was a couple days markets moved that you couldn't capture. But how has everything gone since then?
It's, and to frame it too, so April 9th was the worst case scenario for covered call strategies, especially short dated. And April 9th, the market went up 9.5%. That was the date that the administration tweeted that there was going to be a 90-day pause on tariffs, and things just fired up. So, we got behind. I think we did better than most other zero-day strategies with that event. But really, what's mattered is what we've done since then. And so we got about 60% of that upside, but we left about 3.8% on the table. And so what do you do in those events? And it's totally true what they say, right? Whatever doesn't kill you makes you stronger. It made TSPY stronger. So we changed our prospectus, where we added some tools for catastrophic insurance on those days. So one, we added the ability to do selective call spreads, basically buying a long call to complement our traditional position. And so if there's a gap up, we have insurance against that. There's the ability also to do protective puts on the downside, where we can actually buy a put that can protect against the downside. We haven't used that yet, but we have rules in place that say, hey, based on the market environment, VIX is a big driver of this. As VIX is high, 27 to 29, might be a good idea to put some of these insurance measures in place, because it's like I would liken that to like a spring that's coiled, and a little bit of news can uncork that spring, and in some cases you can't get ahead of it to be defensive, but putting a call spread in really helps you protect against the upside and vice versa for the downside. So that's one thing that we did. Second thing we did was this trade execution. Having fast trade execution is really powerful. And then the third thing that we did was we really gathered deeper market signal intelligence. The advanced analytics that we have, the analogy I would use is we formalized and built into the underlying fintech like a fish finder. So you can see what's below the surface versus just looking at the top surface of the market. And we built that in with all the other tools that we have, and it's really helped us get visibility for not only where to set our opening positions, but most importantly, how to manage the risk through the day, because you can see more to see where the risk is. And that has been super helpful for us. And as a result, you can see what we've done since D-Day, and I'll share my screen just to show the graph that we're looking at.
Sure. And I'll comment, when we first started talking today, I asked you if you had beads of sweat on your forehead, and you said kind of, and then the market went back down and you started explaining that you're not as stressed as before.
It's exactly right, because there's some signals underneath that even though the market price is there, if you make the assumption that it's just going to keep going up because you don't have more visibility in your fish finder, you get the beads of sweat. But when you actually have that visibility, you kind of understand, oh, maybe there's places where there's some resistance or some other forces in play that make it less risky, not more risky. And that is so helpful throughout the trading day when you're managing this. Just to share, this is the Seeking Alpha chart starting April 11th. So that's after D-Day, when the NAV kind of got updated from it, and then what the fund has done since. And the biggest thing is you can see like 14.4% in 2 months is an unbelievable market run by any measure. I should say the 12.3%. We were able to capture all of it with the S&P 500, and then the options have added that 210 basis point buffer, and we continue to add to it. So what that actually has resulted in is, in just over 2 months, we're almost caught up to being even with the market again after April 9th event. And to be able to catch up so quickly has been really a function of the combination of all the things that we've done to strengthen and bolster the fund since that day. And we're really pleased with sort of how the performance has been. But it's not fun to go through those tests, but it's important if you can turn the lessons from those tests into results based on improvements that you make, and that's what we try and do every day.
So, Cy, what's the future distributions going to be? 14% or 15%? Because I noticed you've had some 15s here recently, and then it's been 14.5, I do believe, on the next one. But looking at your premiums, it looks like a 14 is probably a good settling point.
Yeah, I think 14 is a good settling point. It was a balance of two things. You know, we want to be consistent, right? Because people rely on the income component to plan for their daily lives. And so, but there's two things, like when the market compresses, if the distribution comes down with it, it's a bit of a challenge. But guess what? When the market compresses, the option premiums that we're able to collect to fill the gap kind of go up because volatility goes up. So that's why the difference between the 14 to 15, from an absolute numbers perspective, it was about, 27 and a half, 28 cents, but the denominator went down. And so that's why you saw the percentage go up.
Sure.
So we're just trying to be consistent, especially to help people get through those dips in the market, and the fact that option premiums are more ample when volatility is high. And so we had the ability to sort of provide a little higher percentage, but it was pretty consistent from an absolute dollar perspective. But to answer your question directly, 14% is about right for us. 14 to 15. 15 is a max. I don't think we're going to do that consistently. I think we're right in the window of the 14% wheelhouse because people seem pretty happy with that, and it's a nice, sustainable, consistent number that I think we have high confidence we can deliver. No promises, no guarantees, but that is the spot I think that feels really good for our investors.
Talk to us about who's buying all these calls. You're selling calls every single morning, and there's been a question from a couple viewers saying, how many people are buying these? And can you give us a perspective of this from the fund manager's point of view?
It's fascinating. So when I first got into this, learning when you sell something, you don't sell it directly to another, for example, retail investor directly. There's a middleman, and that middleman is called a market maker. And their sole job is to provide liquidity to both sides of the market. So when I sell a bunch of calls in the morning, those contracts are being purchased by the market maker. And the market makers keep this inventory, and then they have an inventory that's created that the other side of the market can then buy from them directly. And they make money on the spread, the bid ask spread. That's kind of what their incentive is to play this role, but it's their job to create that liquidity. So like when I'm selling those calls, it's actually a big institution market maker that's on the other side of that purchase. And when you're buying a call on the other side, you're actually buying it from a market maker. And it's kind of like the bulk model. Like they have a big inventory, and so you can buy the onesie twosies on either side, but they're the ones actually executing it in bulk. And that's how you get liquidity and tighter spreads between the bid and the ask, is because there's that middleman whose sole role it is to provide that liquidity to the market. And they're such an important function to create, liquid and active trading. Because if you didn't have that, imagine how hard it would be to directly match buyers and sellers in real time to get onesie twosie trades actually executed. So market makers are sort of the key to unlock the liquidity that's there.
Besides, some of the other terms that have been thrown out recently has been creation units. Can you give a layman's term of what is a creation unit and what that really means to investors?
Yes. So a creation unit is something that's unique to, for example, ETFs. And it's a similar idea where one creation unit is creating, in our case, 10,000 shares of our ETF. And the person or the entity that does that is what's called an authorized participant. It's a bank, basically. And what the bank does is when there's an order for a creation unit, so let's say there's lots of onesie twosie trades that the market makers have fulfilled, they consolidate it and they run out of inventory. They're like, oh, I need to buy another big bulk, 10,000 shares of TSPY. So the market maker, puts an order in to the bank, the authorized participant, for a creation unit. So they say, hey, bank, I'm going to pay you the value of 10,000 shares of TSPY. It's $24. So I'm going to give you $240,000, and you give me 10,000 shares of TSPY. And so the bank's like, okay, what are the components of TSPY that I have to put in to the shares? Well, for us, it's two things. 99.5% is shares of SPY. So they buy however many shares that is, 450, I forget the number. And then that little 0.5% of cash, and they basically trade that in for a bulk set of 10,000 shares of TSPY, and they hand those shares to the market makers. And then, just like the question on who's actually buying and selling, the market maker now has inventory of those ETF shares, and that's how the whole system works. And that's also why, like, ETFs are super unique, because they're open-ended funds. You can create and destroy shares so that the price of the ETF gets very close to what the price of the underlying components that comprise the ETF are. And that's the magic capability that allows you to do that. Versus closed-ended funds, you have a set number. And so if you don't have the ability to, like, create and destroy, you have a set number of supply, and demand goes up, price goes up with it. So it decouples the underlying assets from the actual market price. So this is the magic thing that allows ETFs to keep those numbers pretty close.
Thank you for explaining that to viewers. I think that was fairly clear for people to understand what's going on when somebody mentions creation units. Greatly appreciate that. Anything else you'd like to share with the audience while you still have some airtime?
Yeah, no, I appreciate it. I think one of the really interesting things, thinking back to the chart that we shared, one of the tools that's made, this uptrend achievable, to be able to actually not only reproduce but potentially outperform the underlying index, is zero DTE options. One of the biggest, we talk to a lot of advisors these days too, including retail folks, and people are always like, well, I don't want to do a covered call strategy because the covered call never keeps up with the underlying index. Well, a traditional covered call strategy, that's generally true, especially in a bull market.
Yeah.
So they'll typically trail. But zero DTE is kind of the new options-based capability, actually gives you a chance in an up-running market to keep up with and potentially even beat a little bit the underlying security. And that's, I think, what we saw since April 11th through today, is just in an uptrending market, when it's not all in one day, you can actually keep a pretty good pace because of the precision of what zero DTE does, because you get better premiums, because you're skipping overnight risk with the short call, because you're skipping weekend risk. You can actually much better manage to deliver market-like returns, or a little bit market beating. And so I think using tools like zero DTE from the finance side, using new technology, new capabilities to really tighten the way we're able to deliver value, all of that really ties back to our mission, which is providing powerful, cutting edge strategies, but making them accessible to everybody. And I talk to, like, my family, and they're like, I don't really understand these nuances, but I like the results we're getting. That's the point. Like, let let the organizations that can bring these strategies and tools that can manage it well deliver the outcome without you having to worry about the day-to-day how. Like, you're retired, Brad. You work too much for being a retired individual, but the goal is, like, take the worry off your plate so you can go enjoy your retirement, and we can bring these really powerful tools and make them accessible to everybody. And that's also why I love ETFs, because, like, we're trading SPX options, right? You know what you have to trade one contract of SPX options? You need $500,000. Not everybody has that. But if you buy a share of TSPY at $24, you get the same relative benefit of being able to trade these things. And that idea, I think, is the whole point. What are we doing to help make these powerful tools that the institutions and Wall Street has always had access to, but let's let everybody have a chance to use them and to benefit from them too.
I'm going to get comments if I don't ask you about TDAC. You mentioned you're looking for that $50 million assets under management. I noticed today that you wrote one additional strike compared to yesterday. I do believe it was one additional today over yesterday. How has AUM been coming along?
It's been actually great since since the middle of April. We've had really consistent growth, and I think that the most important thing is, we're at about 36 million in assets. People ask me sometimes, "Hey, Cy, like, there's other funds out there that have a lot more in assets. How come you guys aren't there yet?" And there's a couple of reasons. One, we're a first-time issuer, first-time fund. A lot of those other funds have what they call seed funding. So they can come out of the gate with 50 million or 100 million because they have those resources embedded. And once you're at that level, then it starts to attract more assets. But we did it the hard way, right? We're doing it as the little guy coming into the space where we're fighting for every dollar to come in. And the fact that we got to 35, 36 million doing it purely organically is a real testament to the retail investors that see it, understand it, and are taking benefit from it. And I just want to say thank you to everybody who's invested, because every dollar that comes in is such a vote of confidence to us, and it means the world. And we're going to fight for every dollar to make sure that we're getting the best returns for you, because we are you. And that's the difference, I think, between Tap Alpha and maybe some of the other institutional ETF providers that are already out there. And the coolest thing too, all of these strategies, all of this technology will be directly transferable to TDAC when it's available, or to any future Tap Alpha fund. And so as soon as we get to 50, I already have all the infrastructure set to say, go. We can take everything we built and use it for the new fund. So fingers crossed we'll get to 50 soon, but just really appreciate everybody who's believed in us and has participated, been part of the community since we started.
Cy, thank you for coming onto the channel and giving us an update. We really appreciate it.
Thanks for having me, Brad. Great to see you.